While there are numerous signs of slowing bullish momentum, the bears have not shown enough conviction yet to signal the next leg down in risk assets. The last 5 trading sessions produced little in the way of progress on either the inflationary or deflationary fronts, which means our analysis in last week's video still applies to the current market. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index. Even though stocks barely moved last week, we did learn some new information. This is September. Here you can see this is a bullish breakout. These levels here where I've got the cursor and here are 1418 and 1419 respectively. You can see we broke below that in October, and last week we tried to come up and retake these levels and we failed. That's not a good sign. You can also see since the breakout, going back to early September, here's the breakout. We've got a series of lower highs and lower lows. This is a downtrend. Another negative sign. We broke below. These are parallel green trend lines here. We broke below it in October. And last week we came up and tried to retake this trend line and were rejected. So we were rejected at this green trend line. We tried to retake this blue, these 2 blue trend lines, which are this bullish breakout, and that was rejected. Both of those are negative signs. So we still have horizontal support on the S&P 500 at 1396 and change. We also have this upward sloping trend line from the low in October and the low in June that comes into play somewhere above 1400. If we move back up and bounce here, potential resistance. We've also got potential resistance somewhere in the neighborhood of 1440. This trend line here acted as support, stall. We've got some stalls in here, support, a stall. So if we come back up, there's no question somewhere around 1440. If we can exceed that, we run into 2 different trend lines in the 1460-ish neighborhood. If we were able to move up in this area, my guess would be based upon DeMark counts in numerous markets that even if we moved and made new highs intraday, we would probably come back down and close here. But that's a long, long way off. We have to keep an open mind and see what happens in the next few weeks. If we take a step back and look at a longer term view, this is the S&P 500. This is a weekly chart going back all the way to late 2006 here in the lower left-hand corner. We've got a downward sloping green trend line here on a weekly chart, acted as resistance here, acted as resistance several times on a weekly chart in this area. Price stalled at the green trend line here and then had a bullish breakout. Now we're back retesting that breakout here where the cursor is. It so happens that the green line also intersects with this red upward sloping trend line that acted as support, and may act as support here. We've got white space here, so you can see that it's possible that if we bounced and filled this white space, we could try to make a higher high here. These are parallel upward sloping trend lines here that have been in play all the way since, let's say, mid-2008. They acted as resistance here and may act as resistance again if we're able to make a bullish advance towards 1500. If we fail here, these trend lines may begin to act as support if price moves lower. This is just another weekly view, S&P 500. This is 2011 in the lower left-hand corner, 2012 roughly in the middle. Resistance here, 1408 when you're using closing prices, acted as support here where the cursor is at 1406. We closed last week at 1414 with a low last week of 1405.95. which says in theory, we came back and retested this 1406 and passed. So you do have on a weekly chart fairly substantial horizontal support at 1406 and 1408. You also have this upward sloping trend line here, acted as support down here in the lower left-hand corner in late 2010, resistance here in October of 2011, somewhat of a stall support here in early 2012, resistance, and now it could come into play again somewhere in the neighborhood of 1400, 1404. This is a weekly risk on versus risk off chart. This is the S&P 500 ETF SPY relative to the Barclays Aggregate Bond Fund ETF AGG. Risk on divided by risk off. Ratio is rising. Risk on, this is what risk off looks like here. Stocks, as we all know, bottomed in October of 2011. Also bottomed in June of 2012. It just so happens that this support line for risk on versus risk off is what we bounced off of last week, the week ending November 2nd, 2012, in the upper left-hand corner. Until we get some resolution here, we don't want to make too many changes one way or another. It's possible that we could bounce higher here, or if we violate this longer-term support line next week, obviously that would be bearish for stocks and commodities and bullish for bonds. From an RSI perspective, you can see we're still holding above 50, just barely. We closed last week at 51. We've also got potential RSI support, this blue trend line here, if we fall a little bit further in terms of stocks relative to bonds next week. This could act as potential RSI support here. This is a weekly chart of EEM, the Emerging Markets ETF, divided by the S&P 500. We own emerging markets, and although they really have not done much, they have been a better place to be relative to the S&P 500. This is 2012 here. This is a ratio building a base, and you can see emerging markets breaking above this downward sloping trend line as they break out of this base. So on a relative basis, emerging markets still look pretty good versus the S&P 500. RSI for the ratio seems to be confirming it with a bullish breakout above this trend line, confirmed here, moving above RSI 50, which tends to be a good sign. And MACD histogram, as of the close last week on November 2nd, was still rising on this relative chart in a healthy manner. The stalemate between risk off and risk on can be illustrated here. This is bonds relative to stocks, intermediate term treasuries ETF, IEF, divided by the S&P 500. When this ratio is rising, it's risk off. When it's falling, this is risk on. You can see here closing prices on a weekly basis, resistance, resistance, resistance. We're running into that here, which could potentially throw bonds down relative to stocks. If you're a bear for risk, you'd like to see this ratio move into this white area here. If you're a bull on stocks and commodities, you'd like to see this ratio get rejected and move into this area here. The stalemate between the two can be illustrated. The stock market peaked between April and May of last year. This is the S&P 500 weekly. This is the topping process here. Most of the ratios and the breakdown in the market started to accelerate after May 1st. And here the S&P 500 took a whole nother leg down. If you look at this ratio, we're really not there yet. We've drawn a line here at May 1st, which says this isn't what you want to see if you're a bull for stocks. Well, we're not quite there yet. Haven't moved into this orange box yet. RSI on this chart after May 1st, when the stock market broke down, clearly moved into this orange box or above 50. Not there yet. Closed last week at 48, so it's possible this could get rejected. Similar with MACD histogram. This is May 1st here, where the stock market accelerated to the downside. You can see on this ratio chart, MACD histogram clearly moved above the zero line into this orange box. We're close here, close to getting a MACD cross, similar to this, but we're just not there yet. Same thing with the rate of change. May 1st, when the acceleration started to the downside in a bearish manner for stocks, rate of change for this ratio was clearly already above zero. We closed last week still below the zero line. These are boxes that we'll be watching next week and the week after relative to the battle between risk off in this case and risk on. Now we're looking at another risk off relative to risk on. This is TLT divided by the S&P 500. This is a daily chart. This looks noisy, easy to understand. This is bonds relative to stocks, and you can see treasuries have not clearly broken to the upside as of the close on November 2nd. So if you're a bear, you want this ratio to move into this area next week. If you're a bull, you want this ratio to roll over. From a bullish perspective for treasuries, RSI downward sloping trend lines, it appears that we've broken above it and tested it. When you're staying above 50, that tends to be bullish for bonds and bearish for stocks. However, when the stock market clearly broke down in May of this year and this ratio shot to the upside, you can see here that MACD histogram was clearly bullish. It's not really what we have in the present day. This is hesitating, and we've actually had the histogram for bonds relative to stocks drop in the last 3 weeks, which looks like very, very little conviction in terms of going after bonds. MACD, you can see the slope here when the stock market broke down on May 1st. This is the bearish acceleration of risk off. Notice MACD black, the slope of it started to increase in a convincing manner. Again, not what we have here. We have MACD black as of the close last week, looking somewhat tepid and looking like it wants to roll over. Just another chart that we can watch going forward to monitor the battle between risk off and risk on. This is a list of the top 10 holdings for the XLP, or defensive consumer staples stock-based ETF. Procter & Gamble, Philip Morris, Coca-Cola, Walmart, CVS, Colgate-Palmolive, Costco. Things you need, basically, with the rationale being that even if the economy is weak, you still need to buy toothpaste, you still need to go to the drugstore, you'll still probably shop at Walmart. Now we're looking at XLP in action here relative to the S&P 500 SPY. This is a weekly chart. So when the stock market here is weak in 2008, as you might imagine, consumer staples are rising and they outperform the S&P 500. March of 2009, when the stock market bottomed, this is the S&P 500 rising. It also stands to reason that XLP began to weaken relative to the S&P 500. This is a rally in the S&P 500. You can see the 22-week moving average for this ratio rolls over. The ratio is weak, stocks go up. 22-week rolling over, ratio is weak, stocks go up. Rolling over of the ratio, in terms of the 22-week moving average, ratio drops, stocks go up. In the present day, this is a little confusing or conflicting relative to some of the weakening momentum that we have. Consumer staples really just don't appear to be in demand. Therefore, what is this telling you? It says keep an open mind. Here we've got the 22-week average rolling over here. That tends to look like a bullish period. for stocks, not a bearish period for stocks. You also have RSI for this ratio trying to retake 50, which would be bearish for stocks, and it's rolling over and having trouble doing it. Also, we've mentioned in the last few weeks that many things look like the peaking process in stocks between April 1st, here where I have the cursor, and May 1st, and May 1st is where things accelerated. You can see the ratio did what you would expect here. Consumer staples were strengthening relative to SPY in this period of risk off here for the S&P 500. And you'll notice right around May 1st, here the ratio went above the 22-week moving average and the slope started to turn up. That's just not what we have here. So we're not saying this is bullish, but it definitely does not look bearish for stocks and commodities. It just tells us to keep an open mind and look at the big picture, look at price, see what happens, and adjust accordingly. Since we had very little movement last week between risk on and risk off, if you go to the Shivako Capital Management YouTube channel, we explain a ratio of the S&P 500 relative to treasuries in this video with the title Bearish Drop or Bullish Bounce. Now we'll just give a quick update of what we covered in that video that shows we still have a mixed bag as of the close on November 2nd. This is an update of the table that we covered in the video we just described. It's a mixed bag as of the close on November 2nd. It's the ratio of the S&P 500 divided by long-term treasuries. RSI on that chart did not close below 50 last week. However, Williams percent R did close below negative 50. This is a bearish signal. This leans a little bit bullish as long as RSI stays above 50. Moral of the story, mixed picture, and we'll have to continue to watch this ratio for clues in the coming week. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.